Hi, this is Stuart Weems and welcome to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights and tips to help you master the game of building wealth. And in this episode, I'd like to talk about how the share market looks like it's switching from value to growth, and that it could create some significant opportunities for investors over the next 5 to 10 years perhaps. So growth investors have been very well rewarded. So if we look at, for example, the S&P 500 in the US, it's delivered an average return over the past 10 years of 14.5%, solely off the back, or at least mostly off the back, of growth stocks. And they're mainly centered in technology. And we'll talk about how much they've impacted the overall return a little bit later in the podcast. However, this year to date, so 2021, of course, value has significantly outperformed growth. And if it continues, as I said, it could create a great opportunity for investors. So let's first talk about what is value and what is growth. So a value approach involves investing in companies that appear to be undervalued by the market. And investors can use a number of ratios or measures or factors to determine whether, in fact, a company is undervalued or fairly valued, including PE ratios, price-earning ratios, book to market, sales to market, and so on. There's a few different, and they might use a combination, in fact, of measures to determine that. The investment thesis behind the strategy is that there's a large body of evidence that demonstrates your starting valuation is a good indicator of future returns. So that is, if you invest when valuations are low, your subsequent returns are high. And it makes sense, right? If you overpay for an investment, then your future return, you've already kind of prepaid up front in overpaying for that stock. So your future return is going to be very little. Whereas if you buy a great company for a fantastic price, then there's a likelihood that your returns are going to be better. And that's not just me pontificating about that. Of course, that's rooted in obviously sound logic, but there's overwhelming body of evidence that supports that. Notwithstanding that, a value approach means that though you tend to invest in companies that have strong fundamentals, so strong cash flow, profitability, stable dividends, strong balance sheet, low debt, those sorts of things. So that's a value approach. A growth methodology is less concerned about whether a company is fairly valued. It's really all about the potential for future growth and mostly about the growth in the share price or company value rather than necessarily growth in fundamental factors like cash flow and profitability. So growth investors are encouraged to mainly focus on top-line indicators such as customer numbers, user numbers, revenue growth, potential for growth in the future. You know, the market could be this big one day, and if we own 10% of the market, then the company's worth $1 trillion, you know, that sort of story, if you like. And it seems like for growth investors lately, the profit is actually not a very attractive attribute for a company to have. You know, profit's not necessarily that important. It's really just all about revenue and top line growth. And I'm not saying I agree with that, of course. I'm being a little facetious, but that's really the growth methodology. Now, if we look at what has contributed to growth returns over the last 3 years, but also in the last 10 years, technology has been a major contributor, particularly the big tech companies in the US, which is the FANG stocks, which includes Facebook, Amazon, Apple, Microsoft, and Google. And even just those 5 stocks have contributed about half of the S&P 500's overall returns. So 5 stocks driven half of the market's returns, and therein lies the risk, right? So we look at the US valuations and the US market and the appreciation of 14.5% over the last 10 years. It all looks risky, but really when we boil it down, we can see really where the risk is, and it's centered in only a few sectors and a few companies, if you like. And if we look at the FANG stocks, most of them are trading at PE multiples of around mid to low 30s, except for Amazon that's trading at a PE, price earnings multiple of 81 times at the moment. It used to be close to 100. but its share price has come off a little bit. So to put that in context, the long-term, very long-term average PE ratio for the S&P 500 is between 14 and 18 times. Now, you can argue PEs for tech stocks should be higher, because they've got more scalability, and so the more that they scale, the more profitable they are, and that would be true to a great extent. But of course, other industries can scale too, and can achieve that scalability. We just look at the businesses that Berkshire Hathaway, Warren Buffett's company, invests in. If you look at revenue per employee, for example, as a measure, has a revenue per employee of over $500,000, and that's significant scale. So you don't have to just be in technology to scale. But look, let's say that PE ratios for tech companies, it's okay for them to be higher. Maybe that means low 20s, but certainly doesn't mean mid 30s. So we can see really where valuations are extended. We can really see the impact of that. And as I said, over the last year, technology has contributed nearly 60% to the index's returns, and over the last 3 to 5 years, it's around 41%. So really, again, 5 companies driving 41% of the results is not really where we want to be, and certainly exhibits some risk. Now, we'll have a look at some data produced or put together by fund manager Dimensional, which is a US fund manager that uses a low-cost, rules-based sort of value overlay indexing kind of methodology. That's a lot of words put together, but I like them very much. I appreciate their methodology, which is very in line with my philosophy. In any case, they've looked at returns of value versus growth from 1926. So we've got 95 years of data. I would say that's a pretty significant data set. And for the first 84 years, which is really 1926 to 2010, the value has been a clear winner by about 3.8% per annum excessive return. So these value investors earn 3.8% per annum on average. Over the long run, that's a pretty considerable outperformance. However, in the last 10 years, growth has beaten value, and in the last 3 years, just marginally, and in the last 3 years, growth has beaten value significantly. So value's given us a negative return of 3.3%, whereas growth has produced a positive return of 17.9%. So there's over 20% there in outperformance of value versus growth, which is considerable. But then if we look at what's driven that, we can get a good sense of, where that risk is. But most notable is the change this year and the reason for this podcast/blog. And in fact, if we look at data, value has started to outperform significantly. So if we look at the first quarter of 2021 in the US, pure value has produced a return of 21%, whereas pure growth 0.8%. So nearly a 20%, more than 20% outperformance there, which is pretty significant. In Australia, the values are different, but the performance is just as stark. So in Australia, value returned 8.5% for the 3 months ending March 2021, whereas growth lost 0.09%. So we can just call that a flat return. So an outperformance of 8.5%. Obviously, our market hasn't done as well as the US market. The US market is certainly more exuberant than the Australian. So what has changed this year? Why has value outperformed growth? And will it continue? And that's, I think, a very rational and reasonable question to ask ourselves. Well, if we have a look at the sector performance, it sort of highlights what's been going on. So in the first quarter of this year, the best performing sectors were energy, financials, materials and real estate. And the worst performing sectors were consumer staples, technology, utilities and healthcare. So it's really kind of the reverse trend to what we saw last year through COVID. The popular sectors during COVID were healthcare and technology, of course, and consumer staples and discretionary. And it's kind of switched around. And if we have a look at the value index, it's underweight technology and it's overweight financials. And that's why we're seeing such stark outperformance, is that the companies that weren't so popular during COVID have become more popular, and the ones that were perhaps overpopular or too popular are far less popular. And probably the things that has precipitated this change is the aggressive rollout of the COVID vaccine in the US and UK, and to a much lesser extent Europe, obviously not Australia, or New Zealand for that matter. But that's okay. We don't really need the vaccine at this point anyway. And so I think the market's now started to get a more reliable indication of how far the global economy is away from returning to sort of pre-COVID levels. Not only that is domestically, in terms of domestic trade and consumption, but also the resumption of international trade, international travel, tourism, and those sorts of things. Plus, we get a sense, particularly for financials, about what the impact at an individual level might be as a result of COVID. So looking at returns, that's great, but we also need to be considerate of risk. And I would say that a growth portfolio at the moment exhibits substantially more risk than a value portfolio. And if we look at the US CAPE ratio, which is an acronym that's CAPE, which stands for cyclically adjusted PE ratio. Essentially what it does is smooth out 10 years worth of earnings and then look at the price earning ratio based on that. And what it's attempting to do is isolate the multiple change in multiple impact in valuation rather than the change from income. And so, a company value can rise for many reasons, but mostly because it generates more income or because its multiple has increased PE ratio, and that's what we're trying to ascertain. So the CAPE ratio is around about 37 at the moment. It's only been higher than this once, and that was around the dot-com bubble in the early 2000s. And the 30s, Black Tuesday, 1930s that is, on Black Tuesday it got to 30 and we're at 37 now. Black Monday, which is 1987, or in Australia we call it Black Tuesday, it was the CAPE ratio was under 20. Again, we're at 37 here. The long-term mean is 16, nearly 17 times. So, when you look at the CAPE ratio, and I've got the links in the show notes, obviously as usual. When you look at the CAPE ratio, you go, well, the market is ridiculously overvalued. If I have a growth portfolio, it probably means that I'm invested in growth stocks that probably are the most heavily overvalued. And most importantly, the CAPE ratio is a pretty reliable indicator of future long-term returns. So 10-year returns has a pretty strong correlation, about 80%. So we know when the CAPE ratio is high, subsequent 10-year returns are low. And that certainly makes a lot of sense, because if you're overpaying for a company, as I said previously, your future returns are low, and that makes sense because if you've overpaid, the likelihood of the price continuing to rise above this overvaluation is probably low. The chance of it correcting is probably high, and therefore your earnings aren't so great. When you have a look at the PE ratios by sector, though, you can see that a lot of this overvaluation at market level is really centered in just a couple of sectors. The first one in the US is consumer discretionary, and that's mainly just thanks to Amazon. It's such a big company on such a high PE. Then there's technology. That certainly looks overvalued, whereas financials historically look relatively cheap. So by adopting a value approach, what it means is you skew away from those risky companies and sectors, and you skew towards sectors that exhibit the fundamentals or the historic results that suggest that they're going to achieve better future returns. So the $1,000,000 question really is, will value continue to outperform? So will the first quarter of this year's results continue to persist? And the short answer is no one really knows. The longer answer is that if we look at more recent data, growth has outperformed value by 2.3% over the last 10 years and by more than 21% over the past 3 years. So over the past 2 to 3 years, I've been tilting my client portfolios towards value, mainly to reduce risk, but also to generate higher returns. And I've done so because the historic evidence demonstrates that growth will not outperform forever. And with each subsequent year of strong outperformance, we get closer to the market turning. At some point, the market will realize that it doesn't make a lot of sense. Or will you earn any returns if you pay 1,000 times annual earnings for a company, which is an example for Tesla. And I don't really know when the market will turn, but 95 years of data demonstrates that tilting towards value will likely achieve better returns over the next 5 to 10 years. So we're never going to get the timing right. It seems like the market has switched now, but certainly I don't know when it's going to switch from growth to value. But I do know that there's overwhelming evidence that demonstrates or suggests that value over the next 5 to 10 years will probably outperform growth, and you have a higher probability. Notwithstanding that, we're reducing the risk in our portfolios by avoiding those sectors that are clearly ridiculously overvalued. So how do you adopt a value approach? Well, unfortunately, there's not a lot of tools available or options available to retail investors. There's a couple of ETFs that give you global exposure. And when I say a couple, there's two. Van Eck and Vanguard have ETFs. I've got the links and the ticker codes in the show notes and on the blog on the website. And then there's one ETF that gives you Australian exposure by BetaShares, which use fundamental indexing. I'm not recommending any or all of these three investments. In fact, I only use one of them, but I'm just highlighting they exist. But probably the most important fact is that there are many low-cost rules-based sort of proven value methodologies that will probably never be available in ETF format. They're in managed fund and sometimes wholesale managed fund format, which demonstrates how incredibly important it is to get a financial advisor to construct a portfolio for you so that you are considering the full universe of investments rather than just what you know or what you can find online. And really, there's only two things that you can control as an investor. You can control how you invest, which means methodology and asset allocation, and secondly, the fees that you pay. So focus on controlling those two things. That what you can't control is how markets will behave. But if value does outperform growth, then the decision to take a tilt towards value today could demonstrate or provide or generate much better returns in the long run. That's a decision you can control. What you can't control, as I said, is markets. So I hope that's been useful. As always, there's more information in the show notes and the blog on the website. And until next week, bye for now.